There are 30,000 private equity-backed companies.
That is way more than I thought.
SpaceX and OpenAI, ByteDance, valued at $300 billion or greater. It kind of puts them in this stratosphere of top 25 or 30 companies in the world based on enterprise value, but they're still private. There was a point in time where the public markets were rewarding high-growth companies, grow at all costs. To transform yourself from a grow-at-all-cost company to a company that's got a line of sight to profitability can't be done in a quarter or 2 quarters. It's probably going to take 2, 3, or 4 years, and it's probably going to take help. I'm on record in January saying liquidity is going to be the word of the year, not because of lack of it, but because of the amount of it. I do think it's still going to happen. Those 30,000 companies I referenced earlier, over a third of them have had hold periods that are longer than 6 years, and that means it's time for the owner to sell. The upside is 10x and the downside is 1x, and I'm going to invest all day long. Well, that math doesn't work if you have 20 downsides in your portfolio and no 10xers, right?
Yeah, pretty quickly you're out of business.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. Today, my guest is Scott Voss, managing partner at HarbourVest, and one of the most thoughtful voices in private markets. Scott's got a unique vantage point, sitting at the intersection of venture, private equity, credit, and secondaries. And in this conversation, we pull that full picture into focus. We start with the big shift. Public markets are shrinking, private markets are swelling, and the line between the two has never been blurrier. Scott explains what's driving this dynamic, whether we're now living in an age of mega venture, and what it means when a company like SpaceX is valued in the same neighborhood as publicly traded giants. We talk about the surge in take privates, why they're happening, what companies are trying to fix once the quarterly earnings pressure is gone, and how private ownership changes the playbook, from cutting headcount to reworking business lines. Then we get into secondaries and the rise of GP-led deals. Scott demystifies this fast-growing corner of the market, explains why it matters for LPs, and shares what innovation looks like when liquidity meets long-dated capital. We also dive into credit, what Scott calls the third voice in the room. He explains how rising rates are reshaping deal structures, the difference between private syndicated credit markets, and why this voice is getting louder in today's environment. And finally, we touch on Evergreen capital, permanent capital, and the unique structure of recent AI mega deals. All this and much, much more after a short word from our sponsors. This episode of Run the Numbers is brought to you by Mercury, business banking for founders and finance pros who want their financial stack to actually work together. Now, I don't plug tools I don't know or intimately use. I've been a Mercury customer for a couple of years now. In fact, I showed the Mercury dashboard to their CFO, Daniel Kang, from their finance team right before we hit record on this episode. It felt like a full circle moment. And what I love most is that Mercury isn't just banking, it's operational confidence. I can send a wire to a podcast editor, I can check capital balances, and I can approve a payment for a freelancer who helped me with a tech stack report, all without bouncing across tabs or praying a PDF exported correctly. Mercury's making a bet on builders. Whether you're issuing your first invoice or wiring 7 figures for a warehouse build-out, it's banking that scales with your ambition. Visit Mercury.com to apply online in minutes and see why over 200,000, entrepreneurs choose Mercury to run their business finances smarter. Here comes my banking voice. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group, Column NA, Evolve Bank and Trust, members FDIC. The IO card is issued by Patriot Bank, members FDIC, pursuant to a license from MasterCard. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials, making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit RightRev.com to see how we make complex revenue simple. That's RightRev.com, where revenue recognition actually works. Did you know that around 40% of manually processed invoices contain errors, missing data, bad codes, duplicates? And those mistakes don't just slow your finance team down, they cost you money. That's why global finance automation matters. It's not just about saving time, it's about keeping your business safe from costly errors. And that's exactly what Tipalti does. Tipalti is the serious AP solution for serious business. Tipalti automates the end-to-end payables process, handling everything from onboarding suppliers to global payouts, all so your finance team can breathe again. More than 5,000, of the world's most ambitious businesses already rely on Tipalti to make payments in over 200 countries and 120 currencies. With baked-in security and tax compliance, Tipalti gives you the confidence to scale globally without adding extra finance headcount. Give your finance team their time back. Don't let bad invoices drain good money. Visit Tipalti.com/run-the-numbers. Tipalti.com/run-the-numbers. Tipalti, serious AP for serious business. Scott, it's nice to see you again, my friend.
Hey, CJ, good to see you as well. Good to be back.
So last time we spoke, I believe it was around Thanksgiving of 2024. I think it's safe to say a lot has changed in the world and the capital markets since then.
I think that's fair. A lot has changed, but then there's a lot that stays the same. And I think some of the ideas we talked about have probably just kind of built on themselves. So I'm looking forward to kind of touching on some of the big themes that are playing out in private markets today.
First theme I wanted to talk about was this line between public and private. And I think it's blurring. And what you had said to me when we were preparing for this is that they have some distinct characteristics still. I want to know what's going on today.
So definitely blurring. And what I tell people is that the advantage of being public is that you're liquid and you're priced daily. And the advantage of being private is that you're illiquid and you're priced quarterly. So even those are two different things. I think for some companies, you're better off in one place or the other, depending on where you are kind of in your development. A lot of what we're going to talk about today, I think we're going to touch on this blurring of the lines between public and private.
I also kind of wonder what the benefits of being public are other than liquidity. We had Howard Wilson of PagerDuty on the podcast, and funny enough, they're in the news of potentially going private again. But what he had walked me through is like there's the liquidity option, so you got to make sure that investors can get their money for betting on you early. You got to make sure that employees can get some money for whatever they need in life. But there's also the aspect of like the credibility around like if you're a core infrastructure for a company, like how do we know that like you're solvent, like if something happens and the reliability around it. And then there's the enterprise marketing part of it too. But I know we'll touch on this in a bit. There are a lot of companies leaving the public market. So I start to wonder, like, what are the benefits and are they being outweighed?
Well, yeah, I think I agree with Howard. I think there's definitely, a path to liquidity that many investors or even early employees are looking for to monetize kind of the value that they built in the company. And the IPO is one of the optimal ways to do it. Also, it does bring credibility to a customer base. If you're publicly traded, I think it just shows that you're institutional quality and you're going to be around for a while. So I think that's definitely a benefit. You have to have, I think, a very stable, established business in order to meet some of the expectations of the public markets, meet them daily and quarterly. And I think we'll touch on the take private idea. And sometimes it's better to kind of step out of the public markets at points in time when that predictability might come into question over a period of time.
And I think one of the reasons why a lot of these companies are staying private longer is the rise of these mega funds. Is it fair to say that we're now living in a world of traditional venture and then mega venture?
Yeah, absolutely. And it's even just larger private equity deals getting done. We'll talk about cohorts, but I have this one narrative I talk about that's traditional venture versus mega venture. And, traditional venture is what institutional investors have been investing in for the last 60 or 70 years. It's investing in an entrepreneur, in an idea at the company formation stage in a sector that's probably emerging, but it's going to become a very important category where you can build a company that's going to define that sector. And you build that company up over time, ultimately exit through IPO or through a strategic acquisition where you become really important to the acquirer. That might be an incumbent where you're kind of encroaching on their space. But more recently, as you noted, this mega venture definition where companies are valued at 50 billion, 100 billion. In the case of SpaceX, they just did their tender at $400 billion. The M&A is probably not an option at that size. It's really just the IPO. But in some of these highly valued companies, including SpaceX and OpenAI, ByteDance, valued at $300 billion or greater, it kind of puts them in this stratosphere of, top 25 or 30 companies in the world based on enterprise value, but they're still private. And the rest of their cohort is probably publicly traded in a large universe or, large cap tech companies that are publicly traded.
Scott, like if we were to look back 10 years ago, it would be a pretty crazy statement to say, oh, out of the top 30, top 50 most valuable companies in the world, maybe 25% of them are private. Like that's a huge shift in terms of where we were.
No, that's right. And I think we're only going to keep going in that direction. Sometimes when we talk in our investment committee meetings, we think could the first $10 trillion company actually be a private company? It's not NVIDIA, it's not Apple, it's not Microsoft. It's, one of those other companies that I mentioned.
And you said SpaceX valuation, that's in the top 25 globally. And you also mentioned like at some point you get so big that you actually have less options. There can become a point where you're too big for M&A. It's like, oh, well, who are the only people in the room who could buy you? Like it's a Google buying a Wiz or something. But like any bigger than that, it's like who could possibly be at the table?
Definitely at that size, if there's somebody big enough to buy you at that scale, the regulator has to step in and you got to get through that whole part of the process. So I think the Wiz acquisition is kind of touching on probably one of the larger or largest deals that you can get done where it's large cap incumbent buying emerging startup.
Scott, you hit me with an interesting stat that the number of public companies has decreased in the last 5 years. How big is that shift?
Yeah, so it's actually the last 20 years. So I'm going to bring you back 2 decades. But if you look at the numbers, the number of public companies has shrunk by about 40%. The data I've seen is, back in 2000, there were over 7,000 publicly traded companies, and I think it's closer to 4,000 today. And I think the question is, well, how has that kind of consolidation happened? I think some have gotten bought, and there's just been M&A that has turned, 2 companies into one. Some have been delisted, but then one of the big private equity playbooks over the last couple of years or longer has been the take private of some of these mid-market technology companies.
Is there like a zone of like valuation of when a company will usually become a target for take privates?
Yeah, if we were having this conversation 6 months ago, I'd say the sweet spot in 2024 was the largest private equity deals getting done by the largest private equity firms were take privates of these mid-market technology companies. So think $5 to $10 billion values. We can and I can identify some of those companies. It's companies like Qualtrics and Squarespace. In the UK, cybersecurity company called Darktrace. More recently, we've seen some take privates where they've kind of exceeded 10 billion and even exceeded $20 billion, which again is moving into kind of a territory where it's not yet the greatest of all time, but it's definitely approaching the greatest of all time.
To get more real on that though, like, well, why do they want to go private?
Yeah, so these tech companies I reference, and I'm going to have a huge generalization here, but I think the playbook is there was a point in time, especially when we were in a low interest rate environment, where the public markets were rewarding high growth companies. This grow at all cost definition. As interest rates began to rise and you're discounting future value at a higher rate, public markets kind of started to have a bias towards companies that were either profitable or had a line of sight to profitability. And to transform yourself from a grow at all cost company to a company that's got a line of sight to profitability can't be done in a quarter or 2 quarters. It's probably going to take 2, 3, or 4 years. and it's probably going to take help, right? So private equity has stepped in to facilitate these take privates, but then the capability or the resources that private equity brings to the table as a value-added investor can also help in that transformation. And specifically, it's probably not investing as much in growth, so you can have more of your revenue drop to the bottom line and become profit. I think some of the transformation that technology companies need to deal with today is around artificial intelligence and how do you AI enable yourselves. And I don't think that's a reason to go private, but it's definitely probably part of the playbook that these companies will be executing on as private companies. The last thing I'll say is when you're grow at all costs, you invest in a lot of people, right? And at some point you have to kind of take a step back and assess where are you getting efficiency and where are you not. Large cap companies like Microsoft and Meta or Goldman Sachs even can lay off thousands or tens of thousands of people and the markets reward them for it. But I think when you move into that mid-cap space, it might be more of a signal of weakness to the market. So if you have to make changes like that, it's better to do it out of the spotlight of the public markets.
Hey, thanks for listening. We'll be right back after a word from our sponsors. So, if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. And so I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com. aleph.com/run. Tell them CJ sent you. Morgan Stanley recently said NetSuite is under the threat of disruption. That's right, NetSuite, the you never get fired for buying it software. So what's the threat? The answer, Rillet. Rillet is the AI native ERP modern finance teams are switching to because it's faster, simpler, and 100% built for how teams operate today. It doesn't take 12 months to implement. It doesn't feel like filing taxes to use, and your accounting team will actually love it. Postscript closes the books in only 3 days. Windsurf, bet you heard of them. They run finance with just 2 people. And Rillet is backed by Sequoia Capital. Yes, that's Sequoia. Unicorns like Postscript and Windsurf and hundreds of other companies have made the switch, and they're closing books in record time. If I were running a finance team today, I wouldn't default to legacy. I'd look at what's coming next, and Rillet is here. You don't want to be that guy at cocktail parties complaining about how bad his ERP is. Wait, am I the only guy who talks about ERPs around a keg? See how fast your team can move. Book a demo at rillet.com/metrics. That's RILLET.com/metrics. RILLET.com/metrics. A messy or missing cap table might not just slow you down, it could cost you your next fundraising round. VCs get flooded with pitches, and if your equity is confusing or missing, they'll move on fast. Fidelity Private Shares is an all-in-one equity management platform that helps you maintain a clean cap table, an organized data room, and a clear equity story. Schedule a demo at fidelityprivateshares.com, mention mostly metrics, and get 20% off. I remember writing about this once, but Microsoft has more people working at the company than the population of Salem, Oregon, which is pretty crazy to think. And those are the companies that they lay off 5% and their stock price goes up 10%. But to your point, If you're a company with a $5-8 billion valuation, you cut employees, like the market looks at that as a panic move.
Yeah, I think that's right. And, the big question for us with all these, sometimes we see portfolios that are full of these take private transactions. And we ask ourselves, like, what's the end game? Like, what does this look at like when you come out the other end? And, fortunately, we're starting to see certain companies go full cycle. So one of the better technology IPOs earlier in the year was back in February was a company called SailPoint. It was brought private in 2022. I'm sure the transformation playbook was somewhat along the lines of what we just talked about. And then back in February, was gifted back to the public markets at a $12 billion valuation. And I think the take private price was somewhere between $6 and $7 billion. And as a public company, it's kind of traded right around that $12 billion number. And then the one that's like eye-popping for me, and more recently, WorldPay, which is existed in portfolios. It's a private company for a long time, went public. And then it was, if you and I were having this conversation a year ago, and we probably actually discussed it a year ago, it was one of the largest take privates of kind of the 23, 24 time period. And it was just announced recently that its large publicly traded competitor, Global Payments, was going to pay $24 billion to actually acquire it. So, we were talking about some of the values on some of these other private companies, but an acquisition at $24 billion when most of the IPOs we're seeing today are like at $10 billion is also pretty eye-popping.
This may be a stupid question, but like I'm just wondering about the relative like magnitude of return some of these investors expect on like the take private to then public again. Because like my rough math on a lot of these is basically you 2x it, but I mean the quantum of money that I guess you're putting out there, that's a lot of money you're returning. Like what's the expectation on returns when companies do this?
Yeah, this again is a generalization. I think as you move larger cap and you're buying companies that are more established, they generally have lower risk. So there's a relative return related to that risk that the investor should expect. Private equity should deliver 15 to 20% returns. And depending on how long you hold, really dictates how much you compound and what your multiple of money would be. But I still think the underwrite for these deals is 15 or 20%. And in many cases, you can unlock a lot of other value, and it could have potentially a venture-like return over, call it a 5-year period, because of all the opportunity that exists on changes that can be made outside of the public markets. I think Dell, 12 years ago was probably the perfect example of this, right? And I think we may have touched on that in our last conversation, but there was a lot of stuff going on in the private markets that unlocked a tremendous capital gain for investors over what was a fairly long period of time.
And just to paint the picture for people, so I think 30 years ago, there were about 8,000 publicly traded companies in the US. Now it's somewhere around 4,000. But what are you seeing in terms of the number of companies out there that are now PE backed?
Yeah, so this is also an interesting stat to look at. There are 30,000 private equity-backed companies.
That is way more than I thought.
Yeah, and their combined net asset value, I think, is estimated to be between 3.5 and 4 trillion. And if you looked at the growth curves of both number of companies and NAV is actually growing faster than that number of companies. And I think what's also true is over the longer period of time, we always talk about IPO as an exit or perhaps sale to a strategic, but the reality is a big part of liquidity in private markets, and sometimes the majority of liquidity during certain times is private markets trading with private markets. And historically, that definition has been a sponsor-to-sponsor trade where Voss Capital is selling to Gustafson partners, and I make my return and you take over responsibility, and hopefully you make your return on the other side.
I'm so glad you brought that up, because I think in the background of all of this, you have two things. You have the secondary market and you have GP-led, and then you also have the credit markets. And so first I want to talk about how the secondary market has stepped in to provide innovation. What have you seen most recently?
The secondaries have been around forever, but they've kind of been a more niche part of private markets. And for most of their life, they've been known as LP-led secondaries, where if big endowment or HarbourVest builds a diversified portfolio of LP interests, at some point we might want to manage that portfolio and we sell it down, and the secondary markets would step in and buy it. But the secondary market has also been really good about innovating on the definition of secondary. And one of the more recent innovations, which is very much kind of mainstream right now, is called the GP-led or the continuation vehicle. And to put this into perspective, last year, 2024, the secondary market in total was about $160 billion in transaction volume, and the GP-led accounted for about 50% of that. And I'll come back to what the projections are by some of the pundits in a minute. But just to kind of help people understand what's happening here, if you think about that original sponsor-to-sponsor deal I referenced, where Voss is selling to Gustafson, if I'm an LP in both of your funds, I get a distribution notice in one hand, but I get a capital call notice in the other hand. And ultimately, I still own economic interest in that underlying company.
Are you happy with that, though? Just to get a
Yeah,
pulse check?
it's part of the model. So if you went back 15 years ago, people always questioned the sponsor-to-sponsor deal, but it's clearly become part of how private equity ecosystem works. And we've had companies in our portfolio that have traded hands 3 or 4 times. In some examples, in all cases, private equity makes a private equity return in those companies. But to bring it back to GP-led, if Voss loves his asset, he's held it for 6 or 7 years, his investors probably want a liquidity event. But I don't want to sell it to somebody else because I think they're going to make good money when they own it. So I bring in the secondary market to put a transaction together and become an economic interest owner in the company, but they don't have to be the value add, right? They don't have to manage the company. But with that offer, I give the option to my limited partner to either take liquidity at that price or stay in the deal and ride it longer. And this has been fairly new. It's probably been around for 5 or 6 years in a mainstream form. As I noted, some pundits, I think TPG has come out with an estimate where that $75 billion of transaction volume for GP-leds in 2024 could grow to $300 billion or more over the next 5 or 10 years. And if that happens, it just suggests that will become another lever or liquidity option available to owners of assets when they need to drive liquidity.
I do have a question, and I've been excited that you're coming on the podcast because I didn't know what to make of it. But didn't Yale make the news because they had a pretty significant secondary portion that they sold off?
Yeah. So, that Yale portfolio got a lot of headline news. And what people should know is institutions like Yale and other large endowments and pension funds, they're always actively managing their portfolios and selling into the secondary market. It just makes sense at certain points in time. Instead of getting liquidity naturally, you kind of leverage this liquidity option that's available. I think the Yale portfolio got a lot of headlines because the endowment tax was on the table. I think there was an expectation that it was going to be significantly more material than it ended up being. But yeah, that Yale transaction was $3 billion in size. I think New York City was in the news. They did a $6 billion secondary sell down. And think about the scale of that. The secondary market 10 years ago could not have taken down a $3 billion portfolio.
It's a huge chunk. So who's on the other end of something like that?
The secondary?
Yeah, like if Yale is selling, and I bring it up too because, and correct me if I'm wrong, but like I'm a history buff. Yale, David Swinson, like they were known for being innovators and investing in illiquid assets in the private markets and having a higher percentage concentration than others. So when I see them now doing secondaries, I'm like, oh, the spidey sense goes off that something's happening here. There's some innovation going on.
Yeah. So in the secondary market, there are dedicated secondary managers, and then there's secondary strategies that are part of a broader portfolio. So it's public. It's in the news. HarbourVest, along with others, were actually on the other side of that Yale transaction. And look, it's not like souring on the industry. It's looking at your portfolio, and maybe you discontinued certain manager relationships, but those require oversight as well. So if you want to, there's multiple reasons why you might consolidate your portfolio.
And you'd said that this has become the GP to GP transaction in particular has become a larger portion of transactions within the last 5 to 6 years. I have to say that's also when there hasn't been as many IPOs. So I think like what is it? Necessity is the mother of all innovation.
No, that's right. Like if you think about your exit options, right? IPO is probably the top option if you want to maximize value, and then you would sell to a strategic where you're going to benefit from synergies, so they can pay more for a company. You could sell to a financial buyer where you might also have synergies where it's some kind of platform acquisition. You do equity or debt recaps, and now the secondary has stepped in. As one entering into private markets, it definitely today presents a better value proposition just at your entry point. But as you noted, all those other options were not as readily available, and we could talk about why. So the secondary market was the only game in town where hold periods were being elongated and LPs were demanding distributions.
Where do you think the puck is going? You gave us the size of the market today. Like, what's going to happen? Is this going to continue to become bigger?
I think we've been in a weird time. So if you go back a couple of years post-COVID, we lived in a world where interest rates were effectively zero and you could borrow money for free. And then all of a sudden, interest rates started rising. And debt is part of the equation. And you got to build a balance sheet to buy a company, and 50% or maybe 2/3 of that balance sheet is leverage. And if it costs more, it adds friction to the system, especially if the debt that already exists on the balance sheet is at very favorable terms. The IPO market was shut. And I think capital markets just had to digest a little bit of this rapid interest rate change that was going on. If you really looked into the numbers, I think the cycle bottomed on liquidity about a year ago. It was probably June of 2024. And if you looked at the numbers in the second half of the year and you looked at the first quarter, things were really starting to pick up and in fact accelerate. So if you listen to experts in January, a lot were predicting that 2025 is going to be a banner year for exits. And then April 2nd hit, a lot of uncertainty hit. A lot of volatility in the capital markets, and frankly, a lot of pencils down for a period of time. I do think, and I'm on record in January saying liquidity is going to be the word of the year, not because of lack of it, but because of the amount of it. I do think it's still going to happen. So those 30,000 companies I referenced earlier, over a third of them have had hold periods that are longer than 6 years. And that means it's time for the owner to sell. Additionally, there is liquidity in the market. If you look at dry powder that sits in private equity funds that's not yet invested, you look at the amount of private credit that's been raised, you look at the amount of secondary capital that's been raised, there's a lot of capital that needs to be invested. And I think once we have more certainty, and it feels like we have more certainty, that capital will be deployed because in all those cases, the investment period is aging and managers are feeling pressure to deploy. I think you referenced the third party in the room, which I think dictates advantage. And we touched a little bit on it. It's the credit markets, right? And if interest rates come down, which we think they're going to, other alternatives of debt enter the market. So if you look at how buyouts are financed, 70% is through private credit, 30% is through the syndicated loan bank market. Private credit costs 150 to 200 basis points more than the syndicated loan market. So July was a record year for that market. It was mostly recaps that were getting done. But if that cheaper debt is available, even if it's a minority of the credit that's used to facilitate these buyouts, I think we'll start to see these assets trade. And if we have more volatility and the syndicated loan market closes, advantage moves back to GP led. I think to the extent they're open, the sponsor to sponsor deal really has a case. So something to watch, I think, over the course of the next 5 months or so.
I'm so glad you brought up the third voice in the room. The third voice in this podcast, private credit. Can you define what private credit is? Because I feel like it's a bit nebulous.
Yeah. So in private equity, for a long period of time, credit would come from banks, traditional lenders, they're called. And then during the financial crisis, private equity stepped in to be a source of private credit to facilitate transactions. It was really kind of created as a result of this crisis that happened within the financial markets. But then over the last 15 years, it's grown up to become a very important part of private equity markets. And in fact, for some sponsors, it's a preferred place to go to borrow, even if it costs more, because it's just more predictable. It doesn't close. On April 2nd, the syndicated loan market closed for 3 weeks. There were deals where the plug got pulled because the bank said, I'm out. And it was like it happened overnight. So private credit has grown and become significantly more material. And if you look at the mix now, 70% of deals getting financed or 70% or more are actually through private credit. Another thing, just bringing back the secondary market, given that this asset class has now really emerged and become scale over the last 10 or 15 years, I think you're going to see more private credit secondary strategies step in and serve the same role that secondaries serve in the traditional private equity marketplace.
Okay. I feel like you're taking me to school here. This is very helpful. What's the link between private credit and the rise there and also the rise of GP-leds?
I don't know that there's a real linkage there because I could be wrong in here. I'm thinking out loud, but could it be in the GP-led, the company that's taking the capital has a really good credit on its balance sheet. It's actually an asset. And because it's not fully trading, it can keep that credit. But if it fully traded, the buyer would have to rebuild the balance sheet, with credit that actually costs more.
And I think what I was poking at is I'm curious if the rise of private credit has allowed certain GPs to raise enough money to buy from another GP, like it's there, and like the debt to EBITDA ratios like make sense of what they'll finance it at.
I mean, there's a lot of debt out there, but the private credit costs more. And if you're refinancing debt that already exists on a balance sheet that's at really attractive rates because it got financed at 21 and you're financing it with, today's rates, a private credit price, I think it actually adds friction. So I think we need interest rates to come down to allow, more active trading. Or else just owners of assets to say, all right, I'm going to take a little bit of hit.
Scott, can you give us a hypothetical example of a deal and the spread and how that changes with rates and getting it done?
Yeah, absolutely. So a buyer, who's putting together their balance sheet to go buy a company, it's comprised of both debt and equity. And this is very much a generalization here. If you look at, back over time, and let's say an EBITDA multiple with attractive debt markets might be 15 times, but when debt costs more, it might be 12. And you look at the mix of debt and equity to build that balance sheet, you might see the multiple of EBITDA for equity stays constant in every market and every cycle. But as debt becomes cheaper, it's the debt multiple to EBITDA that becomes greater, and that drives the purchase price multiple. And, again, kind of where we talked about before, if you bought an asset when debt was cheap, you could pay more and now you want to sell it, but you're going to get paid less because it's more expensive. That might just cause you not to sell yet, right? Especially if you think that interest rate reductions are not that far down the road.
Okay, got it. And now I'm tying together the funds that are getting more active in this, like BlackRock, Blackstone, Ares. Any other names come to mind in the private credit market?
Yeah, those are the big ones. They're what I would characterize as the category killers. There is a market that lives below that that's more focused on, more mid-market type deals. But if you look at the scale of capital of the ones that you referenced, it's orders of magnitude greater than those that live kind of below. And some of the ones that live below are multi-asset managers. They give, they're investing across all private markets, as are, Ares and Blackstone and Apollo. So, but those are the, they probably constitute the majority or super majority of the market.
Is there like a fundamental risk, though, that these private credit funds are less regulated and we're building all these AI companies up on it? I mean, like, I don't know. There is kind of a voice in the back of my head that's like, have we seen some of this movie before?
Regulation is a hot topic. So, one of the advantages of private markets is that they're less regulated and allows them to kind of be nimble and do things. I think if investors start getting burned, the regulators will step in, but it will also stifle the opportunity that exists in private markets. And this is kind of where the investor needs to really be informed. You need to invest in institutions that you can trust, that have proven to navigate tough market cycles and have invested responsibly over a long period of time. And I think there's a bigger dispersion in private markets because of the lack of regulation. I mean, look at crypto, right? So crypto has become a feature category within the venture capital industry, not really regulated. And although there's some really amazing technologies related to blockchain and cryptocurrency founded by amazing entrepreneurs, it's also attracted some bad actors that have dominated the headlines.
You come at it from the investing side. I come from the operating side. And what I'm trying to piece together is the distinction in roles between the syndicated traditional credit market and then the private credit market that we should be aware of. And you'd mentioned earlier that a lot of the private equity players get involved and they will take like a hands-on, like value-add approach. Is that similar? Like if you think about like taking a loan from a bank and then taking a loan from private credit, like will they get more involved?
So look, in a bad deal, the term "hand the keys to the bank" is used. I think private credit probably has a better ability to do a workout because you know who's at the end of your source of capital. In a syndicated loan, it's who's gonna take responsibility for the workout. Right? So I think that also is a bit of the advantage for private credit.
And you said that it's usually a bit more expensive, maybe 1.5 to 2% more expensive to work with private credit. What do you get though that's the benefit? Like you get the speed of getting the transaction done. Is it like easier reporting requirements?
Yeah, I think there's a lot of advantages, but I'd say the number one is just the predictable actor on the other side that gives you certainty of close. And you never know when there's going to be just volatility or uncertainty that all of a sudden hits the market like we saw in April. I think private credit has proven that it's just more, you need certainty and you're willing to pay for it.
So we've gone through some of the trends in the secondary market, particularly with GP-leds, and we've touched on the credit markets. Something else I've been wanted to ask you about is evergreen and permanent capital. Those terms are getting thrown around left and right. And I have a confession. I don't really know what that means. Like how does permanent capital work? People need their money back, Scott.
I think in the old world, the use of evergreen probably captured both of those definitions, but now in the new world, evergreen is also affiliated or associated with something that's called semi-liquid. So, and evergreen has been around for a long time, but it's existed in corner cases because many institutional investors did not necessarily require it. Institutions could invest in closed-end drawdown funds, and they had kind of the operational infrastructure to deal with that. More recently, the reason you read about evergreen is because wealth is now moving into private equity, a place that it hasn't really been in the past. So think individual investor, even think, target dated funds or ETFs. And they're demanding a structure that looks like evergreen. And first, I'd say it looks and feels more like a public equity investment than your traditional private equity investment. So that gives comfort. The investor steps into something that's either fully funded or nearly fully funded, so they don't have to deal with the drawdown, scenario where it takes you 5 years to get your capital fully invested. Also, from an administrative standpoint for the individual, it's just much more efficient. And then finally, even though private markets, duration and illiquidity should be part of your original underwrite, this term semi-liquid is used. And what that means is an investor has a contractual right to redeem up to 5%. Like in a base case scenario, 5% of their net asset value per quarter. So over the course of the year, you could draw down 20% or redeem 20% if you wanted. Now, I want to click on that number because if you looked at a mature private equity portfolio from any big institution, we mentioned Yale, New York City, HarbourVest, on average over a long period of time, the industry tends to distribute out 20% of NAV just through traditional liquidity measures. But there's volatility around that. So on the best years, you might get 30% of your capital back, 30% of your NAV back. But on the worst years, so think of best of years in 2021 when liquidity was everywhere. The worst of years actually have been more recently over the last couple of years where investors are getting on average about 10% of their NAV back. But it's that security that you can get liquidity if you want it, 5% liquidity if you want it per quarter, that I think gives investors increased comfort, and that's what they're asking for. But the last thing I would say is anybody who's adding private equity to their portfolio, whether it's through traditional drawdown or evergreen, should not assume that that's the part of the portfolio you go to first if you got to take out a mortgage or pay for your child's kind of tuition, right? There should be 90% of your portfolio that's got better liquidity feature than that. I do want to touch on permanent capital because this used to get captured in the evergreen definition until the semi-liquid thing stepped in. And this is more on the institutional side. This is where, a big institution that doesn't need liquidity, it just wants to invest its capital and recycle it continuously and compound at 15 or 20% or whatever the industry can do for them, and just have that be an NAV grower. Oftentimes they'll partner with some of the names that you referenced on the call here. It doesn't get talked about as much, but I think it's also an innovation in the market. And I see this world where at some point that permanent capital vehicle that doesn't require liquidity might decide somewhere along the way it's going to do effectively a tender, and it's just going to sell a slice of what it's built into the secondary market. The natural buyer of that slice might be the Evergreen fund, because that portfolio has a profile that Evergreen fund is really going to like, because it's mature and it's liquidating out, and it can satisfy that liquidity feature that's required by investors.
Something that I think about a lot is like 20 years ago, if you wanted to get into Amazon and ride that stock for a couple of decades, you could do that. But now that companies are staying private so long, like a Databricks, how do I possibly capture the value of that as an investor? It almost feels like, a Thrive Capital or somebody throws money at them. Now they can stay private longer. They get to accumulate the value. I'm just trying to link that. It sounds like people can get in their personal portfolios exposure to these private assets through these different vehicles now.
I mean, that's a case for a private market allocation. If you want to get into these companies earlier than, the public markets are going to let you, or maybe will never let you because they never go public, you need a private market allocation. And I think this will also kind of stratify the broader private markets and actually create different definitions. When you say, oh, I have a private market portfolio, I think the next question should be, well, how and when are you accessing private markets? Is in the case of Databricks, was it at the company formation stage when it was an entrepreneur and idea, or was it when it raised $10 billion at a $62 billion valuation, right?
Yeah, those are two completely different ball games. It is fascinating to trace how you access these different assets through the different cycles. Scott, what excites you the most out of all these different structures that are popping up over the last couple of years here?
I think just that they're available. I think making private markets available to wealth is awesome. However, private equity and private markets has a role in this game, and it's to educate that investor on exactly what they're getting and what they're not getting. That's part of why I'm talking to you today. I want to make sure that investor understands. So, but having, for an individual to have the ability to build a portfolio that looks like an institutional investor, whether it's the largest sovereign wealth funds in the world or the largest endowments in the world, I think is an amazing opportunity.
I also think it's important for CFOs, COOs, and CEOs who are running companies who may have backing from some of these vehicles to understand who's on their cap table, because I do feel like you need more of a capital markets knowledge to run some of these companies than you did prior.
Like what exists in some of these big, especially venture-backed deals, is the founder entrepreneur actually wants to know who's on the cap table. So even though an investor may be able to access economic participation in the company, it's probably coming through some kind of vehicle that is managed by a team or an individual that the founder trusts and really wants on their cap table, right?
Yeah, and I also think it's important to know how much, what the expectation is going to be around value add. Who's going to help to pick up a shovel if something goes wrong? Like, you got to know who to call.
I think that's right. Yeah.
Scott, what are you seeing with AI deals? There have been a number of high-profile acquisitions, if we want to call them that, since we last spoke. Windsurf gobbled up by Google, Scale AI by Meta. What are you seeing there?
Yeah. So, when ChatGPT was the AI kind of big reveal. That was like the big moment where it kind of went mainstream. But the reality is, venture capital in particular has been investing into AI companies for a decade or more. It's just that was the big unlock. But I think what we're seeing is interesting, because most investors would say we're in the early innings of the AI innovation cycle, which would suggest that portfolios are fairly young and nascent, but we're seeing a consolidation already happen in the industry. So, Wiz is an AI play. It's at the intersection of cybersecurity, cloud computing, and artificial intelligence. So that's Alphabet, taking a shot at that deal. Scale AI, at a $14 billion, 49% interest paid by Meta is an amazing deal. And that's Meta saying, we need to have a leadership position in this space, and this is how we're going to do it. And then even if you move down the stack, there have been some notable acquisitions by more traditional incumbents. So There's a company called MoveWorks. It was founded back in 2016. It was acquired by publicly traded ServiceNow, which has a $50 billion market cap. They paid $2.8 billion for it. And it's basically an AI enabler for ServiceNow. So every company needs to somehow AI enable its business and its business model. Some can build it from within, but in other cases, they'll go out and buy it. And I think Dotmatics is the same. This is a company that was bought for $5.1 billion by Siemens. And it basically AI enables the life sciences division within Siemens. And so I just reference these because they're not like emerging companies that still have a long runway ahead. They're actually fully exiting, and investors are getting their capital back. And they've lived in portfolios for 8 or 10 years.
It's crazy to think that a lot of these companies have lived in portfolios for 8 to 10 years. I mean,
so CJ, we have this slide that shows all the subsectors within venture capital. It's at cybersecurity, deep tech, space, AI, machine learning, digital consumer. And forever, we've had this slide in our deck for 10 years, and we had this AI ML category where companies existed, but you really wondered, is this ever going to happen? And then ChatGPT just broke the dam, right? It's really interesting.
I remember being at PwC doing advisory work in 2013, Scott, and we had a slide where it was like consumer, fintech, hospitality, whatever else was on it. Then it's like blockchain, Internet of Things, AI, ML. And I was like, is this real? Are we ever going to see this slide actually have logos on it?
So let's talk blockchain for a minute. I mean, it's all about crypto and tokenization and all that kind of stuff. But blockchain is this infrastructure that I think deserves to exist across different types of sectors and industries. In the world that I live in, financial services, it's already here, but it's not crazy to assume it becomes industry standard where every investor subscription sits on blockchain. It's the system of record. It's tokenized. It allows for more free trading of the asset class that frankly doesn't exist broadly today. And I think that's an opportunity for all of us, but it's also a threat to our business, which is really kind of doesn't have as much, flow or ability to trade as the public markets.
It's like the snake eating its own tail. So some of these concepts we're talking about, though, I do feel like we're just now using the name, whether it be machine learning or AI or tokenization. It's no, we were doing all these things before. We're just taking a different label and putting it on it, and because it's cool to call it that.
I think that's right. In the space, you see the stuff that's just been rebranded, but then you see kind of behavior or the way you use tools. It's totally new and innovative, and probably has brought tremendous efficiency to your world. And then even just think about how you use some of these technologies right now versus maybe 6 months ago, and it's totally different. Anthropic is one of the featured LLM companies. It's been very successful, and I'm going to butcher this quote, but Dario Amodei, who's the CEO of Anthropic at the AI Summit in Paris earlier this year, said by 2027, we're going to see AI systems or AI agents that constitute a very smart nation state. When I hear that, I'm like, okay, will they have a seat at the table, at these multilateral negotiations where we're talking about climate change and AI governance or tariffs? And it won't be long before we know if that's true or not, if he's right about the 2027 date, right?
That's like some Black Mirror stuff, Scott.
You referenced that on our last pod, too.
We're both fans of that show, I think. Oh, wild times. To connect two things we were talking about, the rise of private credit and AI, I was reading an article recently that one of the biggest recipients of all this private credit are the companies who have to invest so heavily in CapEx. And part of it is awesome because it's funding this next wave of innovation. But the other part of it is I hope we don't get over our skis here, and all of this debt, similar to the mortgage market was a long time ago, it's consolidated in one area and there's less visibility of what's going on. So it's kind of at the intersection of regulation, but also making sure we fund innovation and make sure companies can push forward.
Yeah, let me break that down for a minute. Before we talked about how some of the large cap companies can, lay off thousands of employees and get rewarded for it by their stock price going up. I think the same holds true with AI investment. You see these large cap companies who are spending more CapEx in AI, eye-popping numbers. And the more they spend, the more credit they get. And I don't know if this is true or not, but some of these mid-cap tech companies that go private that I talked about earlier, maybe they too have to invest in CapEx to invest in AI, but they're not going to see their profitability go up. And the best way to do that is outside the public markets. And now we're kind of moving into that phase where you're supposed to see the efficiency, right? You're supposed to see the benefits of that investment start to trickle down and hit the bottom line. And I think it's a really good point and observation.
Yeah, if I was to put my tinfoil hat on, though, I would say that there is an incentive for a lot of these really large funds to keep funding these private equity companies who my friend Kyle Harrison of Contrary Capital calls hungry hippos, because they're able to actually consume that much capital. And the upside is infinity. The downside is technically losing 1x. And 2% management fee is pretty great on that.
I learned a lesson when I first joined this industry. Our CIO today, when he was a VP back then, took me on a roadshow through Silicon Valley. And there was one very well-known investor who said, the upside is 10x and the downside is 1x, and I'm going to invest all day long. Well, that math doesn't work if you have 20 downsides in your portfolio and no 10xers, right?
Yeah. Pretty quickly you're out of business. Scott, you had some great career and life advice last time you were on the pod. Before recording this one, you said you had an interesting dinner convo where the topic of nostalgia came up. Can you take us through that?
Yeah. So first I'll talk about the dinner conversation, and then I'll relate it back to just a moment that I had this weekend that kind of made me very nostalgic. So we have a few families that we vacation with every year, and their destination vacations. And one thing we try to do is the parents around the table is just no phones at the table. We're all gonna communicate or socialize with each other. And sometimes it's a card game and sometimes it's a topic. So I introduced the topic of nostalgia. And, I'm 55 years old. So it's easier for me to understand what nostalgia is. Well, when kids are younger, they don't know what it is because they're frankly not in the window to be nostalgic.
Yeah,
so,
they have nothing to be nostalgic about yet.
And I may butcher the definition, but my definition of nostalgia is when there's either a photo, a song, a movie, or an experience that kind of brings you back to a time earlier in your life that puts a smile on your face. In my life, and I'm like, I think I've heard this said by others, it's like you have three parts of life. It's the time that you learn, the time that you earn, and the time that you return. So let's break that into, 1 to 30 years old, and then 30 to 60, and then 60 to 90. And I hope I sprint through the finish line in that example. But if I bring you back to the third part of the first phase, when I was 20 to 30 years old, this is the 1990s. This is such an important part of our lives. Like we just graduated high school or college. We're getting our first job. We might have earned enough money to buy our first car. My first car that I bought, by the way, was a 1989 white Nissan Stanza with, blue fabric interior. It had 90,000 miles on it, and I drove it for a decade until it had 290,000 miles on it. And maybe even, we move out of the house and we have our first apartment. Mine was actually like this illegal apartment above a garage in Bridgeport, Connecticut. But I'm going to go back to the car. So in my 1989 Nissan Stanza, we all had that lunchbox size CD carrier, right? That probably had 10 or 12 CDs. And you think about the bands in the 90s, right? And there's iconic bands like the Foo Fighters or Pearl Jam or Oasis that can sell out stadiums today. But there was a group of bands that defined my 20s are not going to sell out stadiums, and they define the 90s. I think of bands like the Goo Goo Dolls, the Gin Blossoms, Toad the Wet Sprocket, what other ones? Counting Crows, Green Day, maybe the Wallflowers. There's a list of them. What's fascinating, I'm very nostalgic now because a lot of these guys are on tour. They're on the road, and they're playing venues that are 2,000 or 3,000 people. I mean, I went to see the Counting Crows the end of June at the MGM in Fenway. The Goo Goo Dolls are playing up in New Hampshire tomorrow. I think they're playing down by you at Bridgeport on the 8th. Gin Blossoms I saw are playing in New Haven on August 14th. So what's cool is I went to at the Counting Crows concert. I'm walking around. I'm like, these are all like people like me, right? They're reliving. They're nostalgic. They're reliving this moment when they were in their 20s, when they had their first job and they were trying to figure it out, when they bought their first car and they moved out of the house, and it just kind of it's such a cool part of our lives, and it's very dynamic. And, and then you get on these rails, right? You get married, you have kids, you have your career, and you're rail riding from 30 to 60, right? And anyway, that's my nostalgia story.
I love it. And I just listened to Mark Hoppus, the bassist for Blink-182, came out with a book, and like that's the band for me. Like if I was to compare it, and he talks about like the era and time where he's just trying to figure shit out. Like he's just trying to like make it work. He doesn't have like grand ambitions or anything. But like when I was listening to that, I was definitely in that mindset. I was just trying to figure it out. I had no idea what I wanted to do with my career. Like I remember like being in high school, driving around in a pickup truck, listening to it and stuff. But now I'm very much in that, if you were to say learn, earn, and then return phase, I'm like trying to charge as hard as I can in that earn phase, in my 30s with 2 kids. And it kind of brings you back to like a simpler moment before you knew what rails you were going to be on.
Yeah, I agree. And what I got kids in their early 20s, and I'm like, just go out and try a bunch of stuff, because you want to have a lot of different experiences. So when you get on those rails, they're the right rails, right? You're not going down the wrong path. So anyway, that's my nostalgia story. What I will say, if I took it back to the dinner table on this vacation, such an engaging conversation from everybody around the table. It was actually really interesting. So any listener out there, if you're trying to have that conversation at the dinner table, let's talk nostalgia and what makes you nostalgic. Right.
So I've hosted 4 dinners this year with CFOs. We get 25, 30 of them in a room. We've done them in New York, SF, and Boston. And instead of asking like, what's your favorite metric or something, we go around the table, we say, what's your name, company you work for, and what was your favorite band in high school? And you get some like awesome answers and like people cheering at the table and like saying, remember that song? And it's cool just to see like the human side of people.
Yeah. And look, all those bands I just named kind of fall into this one kind of archetype or cohort or whatever. Like I love the glam metal bands at one point. I was like a grunge Seattle guy at another time. And I won't even tell you what I am today. I'd embarrass myself.
All right. Last question before I let you go.
Yeah.
Have you made it out surfing this summer yet?
I hope I don't look jet lagged, but I just returned from Australia. I was in Australia all last week. And the first time I ever surfed, I was in Australia. I was at Manly Beach. It was 30 years ago, the first time I ever paddled out on a surfboard. So I had to go over to Australia for business, landed on Sunday morning, walked to Manly Beach, did not expect to surf because it's wintertime, but it was 75 degrees. It was a really cool little wave, and I went and rented a surfboard and caught like 12, 15 waves. So it was epic. The water was cold, so when I got out, I felt like my feet didn't exist and I was walking around on stumps. So there's a little place down at the end of Manly called the Sunset Grill, and they have a deck on top with heaters going. So I went and got an IPA and hugged the heater for a while. And it was a special experience.
That's what life's all about. Well, Scott, always fun to jam out with you, man. I appreciate it.
Awesome. Take care, CJ. Good to see you.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.